Okay, we are recording. I am doing this recorded lecture for chapter one to go over the chapter one PowerPoints together. And then again, when we're in class together, we'll work through some of the exercises and problems and calculations and things like that. So I am going to share my screen with you and get the PowerPoint pulled up. And again, these will be posted in Owlnet for you guys. Let me get rid of my face so I don't have to look at myself the whole time. Okay, so chapter one, introduction to cost accounting. So, essentially, cost accounting, which is part of managerial accounting, basically we're preparing information for internal users, namely managers, to use for decision-making purposes, right? So some of what cost accounting includes is, for example, analyzing material cost, labor cost, overhead cost, providing management with information that relates to the different costs that go into cost of goods sold, and helping management make decisions about, for example, production processes or other current operations, right? So, again, overall, providing the financial and non-financial information to managers for decision-making purposes, right? So just like it shows here, management uses this information, again, for decision-making purposes and deciding how to allocate resources in the most efficient and profitable areas of the business. All right, so the types of businesses that use cost accounting, every company uses cost accounting in some degree, right? Because even for, merchandisers, manufacturers, service businesses, I mean, we need to be able to determine, for example, how much it costs to manufacture something, and then in turn, how much we can sell it for. Same thing with merchandising. We need to know what our cost per unit is, or what our cost of the merchandise is, so that we know what we can sell it for, right? Same thing for service businesses. I mean, we need to know how much time it takes, for example, to complete a service, so that we know how much to charge for it, right? So, I mean, every company uses cost accounting in some capacity, right? Our book will mainly focus on the manufacturing process. And in the manufacturing process, and this is where we get into our cost of goods sold, is made up of materials, labor, and overhead. Because in a manufacturing organization, they purchase raw materials, and then through the production process, turn those into a finished good that would be ready to sell. So, and I think we see this in the PowerPoint as we go through, and we'll talk about this in class together as well. But when we think about a manufacturer, we think about, for example, a manufacturer's balance sheet has 3 inventory accounts, right? Where a merchandising company would only have 1 inventory account. Merchandising company would have 1, merchandise inventory account, and every time they purchase inventory, they debit merchandise inventory. Every time they sell inventory, they credit merchandise inventory, right? So manufacturers, though, they have 3 inventory accounts on their balance sheet. They have raw materials inventory, work in process inventory, and finished goods inventory. And again, we're going to talk about each one of those as we continue through the PowerPoint. And again, those finished goods, that finished goods inventory, are the goods that are available for sale. Again, even service businesses such as health clubs, accounting firms, hockey teams, although they sell services rather than products, they need to have some type of cost analysis to determine, for example, how much to charge for the health club membership, or depending on the job, how much to charge at the accounting firm, what have you. So and even not-for-profit agencies. The company that I worked for most recently was a not-for-profit association, National Association of Electrical Distributors. So, you know, even then, we needed to know, for example, you know, how much how much a product costs, so that we know how much we could sell it for, or you know, how much. For example, we did a lot of conferences where we brought together manufacturers and distributors within the electrical industry. So we need to know, you know, how much it costs to put on that conference, so that we know how much to pay for registration, how much to charge for registration fees, right? So any type of business, you know, uses cost accounting in some capacity. All right, so this kind of shows you how raw materials flow through to make finished goods, whether it's goods or services. So if we think about inputs, right, whether these are human resource or other raw material imports, I guess they're you know, showing us here maybe wheat or corn, or, you know, it could be rubber, some type of metal, could be natural resources, capital investment. So we take inputs, and through the conversion process, we turn those into outputs, either goods or services, right? Again, for our purposes and in the book, we're going to focus mainly on manufacturing processes. But these are, some of these are applicable to service and merchandising organizations as well. All right, so uses for cost accounting information, you know, again, overall, through cost accounting processes, we can look at material cost, labor cost, overhead cost. We can do variance analysis to determine if we're favorable or unfavorable. We can look at budgeting versus actual results. Things like that are all part of cost accounting, right? So just like it shows here, the information produced by a cost accounting system provides a basis for determining product cost and selling prices, and helps management to plan and control operations. And we'll see this again as we continue through the textbook. But when we're able to determine cost per unit, and so cost per unit would be made up of, again, of the three main manufacturing costs: materials, labor, and overhead. And using those, we're able to determine cost per unit, and then from there able to establish selling prices, and budgeting. You know, once we know that unit cost, we can establish budgets, production budgets, material budgets, labor budgets, overhead budgets, budgeted financial statements like the budgeted income statement, budgeted balance sheet, you know, several different things like this. So, you know, overall, again, you know, used for determining product cost and pricing, planning, and control. All right, so kind of the distinction or differences in financial accounting, management or managerial accounting, and cost accounting. So financial accounting, again, is aimed at external users. So we have to follow those generally accepted accounting principles. We have to prepare our financial statements and our financial information according to those generally accepted accounting principles that have been put forth by, as we know at this point, the Securities and Exchange Commission, the Financial Accounting Standards Board, the AICPA. So aimed at meeting the needs of external users. Although we, you know, of course, we look at our financial statements internally as well, right? But we have to prepare that information according to those regulatory agencies, so that they're available for the use for external users, right? Management accounting, just like it shows here, focuses on historical and estimated data that management needs to conduct ongoing operations and do long-range planning. So, you know, again, management accounting, cost accounting, they really go hand in hand together, because when we think about some of these internal management accounting needs, you know, for example, We do, you know, cost, value, and profit analysis. We do budgeting. We do cost variance analysis. We do break-even analysis, target income analysis, you know, so several of these things that we do in a managerial accounting realm are also done through the cost accounting processes. So they really go hand in hand together. And then cost accounting includes those parts of financial and management accounting that collect and analyze cost information. So, you know, again, really the terms are synonymous. Managerial accounting, cost accounting, you know, it's really, really very similar. This kind of Venn diagram, I guess if you would call it that, highlights those differences: financial accounting, cost accounting, managerial accounting. And again, as you see here, both financial and managerial accounting rely on cost accounting procedures and cost accounting information. So they really are all three interrelated in that way. Financial accounting focuses more on preparing information according to the regulatory agencies for external users. Managerial accounting focuses more on internal users and preparing internal reports for decision-making purposes, right? All right, so here are our three main manufacturing costs, and we're going to do an exercise the first day of class where we get practice kind of going through and distinguishing between these, but overall, we can divide all costs into either product costs or period cost, right? So we can divide all costs into either product cost or period cost, right? Okay. So then if we drill down on each of those, if we're thinking about product costs, we can divide all of our product costs into either direct labor, direct material, or manufacturing overhead, or as it's also called, factory overhead, right? Factory overhead, manufacturing overhead, same thing, right? So our product cost can be divided into three categories: direct material, direct labor, manufacturing overhead. And then the period cost, and so product costs are those costs related to the production process. So to the factory, to the manufacturing plant, to the assembly plant, related to the production processes, where period costs are the expenses not attached to the product. So this is where we get into selling, general, and administrative expenses. And you know, we've talked a lot about those. I know that if you have already taken Principles of Accounting 1 and 2, and I know that you guys have, Principles of Accounting 1 and 2, we talk about those selling, general, administrative expenses. Intermediate accounting, we talk about those selling, general, administrative expenses. So, you know, again, you see them again here, period costs, the selling, general, and administrative expenses, not related to the production processes, but related to the administrative side of the business. And so the best example that I can kind of, and we could come up with several examples, but the best example that always comes to mind for me that I can think of is if you think about a large company like General Motors, okay? General Motors has a production facility here in Wentzville, Missouri. And at that production facility, they make the GMC Savannahs, like the big white kind of work vans. So any cost related to that production plant in Wentzville, Missouri, any of the costs related to that plant are product costs, right? We can divide those into direct labor, direct material, manufacturing overhead. Okay. General Motors also has their corporate headquarters in Detroit, Michigan. So if we think about the corporate headquarters, this is where all the administrative people work and the marketing people, and probably all of the finance department, the accounting department, things like that. Those are our period cost. Selling, general, and administrative expenses, costs that are not attached to the product or to the production facility. Okay. All right, so some of these classifications, and again, we're going to do an exercise like this in class together where we get some practice distinguishing between these. So I'm not going to read through every line of this. These PowerPoints will be available for you to go back and look at. But when we think about bicycle tires and wheels, okay, so if we are a bicycle manufacturer and we're thinking about bicycle tires and wheels, well, that is a variable cost in a sense that the more bikes we produce, the more tires and wheels we need, right? So that's a variable cost. That is a direct cost, and that's a product cost, right? That relates to the product. Same thing with wages of an assembly worker. Again, these are variable in the sense that the more units we produce, the more hours, the more direct labor hours we have to pay for. So this is a direct cost of the product, right? So it's a direct cost, it's a product cost. But now when we look at advertising, for example, so advertising generally is considered a fixed cost, but it's not directly related to the product. So it's an indirect cost and it's a period cost, right? We can see production manager salary. Again, production manager is an indirect cost. The production manager is not on the assembly line turning raw materials into a finished good. So, you know, while it's considered a fixed cost, it is considered to be indirect of the production process, but it is a product cost. So, you know, again, I'm not going to go through every line here. We're going to do an exercise where we get practice differentiating between these different types of costs. So that'll be fun. Okay, so direct materials are the materials that are directly related to a product, right? So the materials that can be easily associated or readily traced to the finished good. So it's giving us the example here of the steel that is used in the frame of a mountain bike. You know, we could come up with 100 different examples of this, but let's you know, think about, okay, the General Motors example. So again, General Motors, they have the assembly plant. It's in Wentzville, Missouri. They make the GMC Savannah. It's like a big white work van. And so, you know, when we think about the GMC Savannah, okay, well, the windshield, that's a direct material cost. The tires, the wheels, that's a direct material cost. The seats, the upholstery that goes on the inside, that's a direct material cost. You know, a lot of them work vans come with like shelves on the inside. That's a direct material cost. The engine or the motor, that's a direct material cost. So direct materials are those materials that can be easily associated or readily traced to the finished good, right? Direct labor, again, direct labor cost or direct laborers are the individuals that are, you know, in the production facility turning the raw materials into a finished good. So they are the assembly line workers. They work in the manufacturing plant. They work in the production facility on the assembly line, turning raw materials into a finished good, right? So they're using the example here, wages paid to a mountain bike assembly worker. You know, again, using the example of the General Motors plant in Wentzville, Missouri. Those individuals that work on the assembly line, they are the direct laborers, right? All right, factory overhead. So, excuse me. If it's not a direct material, if it's not direct labor, then it falls into this factory overhead cost bucket, right? So if not direct material, if it's not direct labor by default, then it falls into factory overhead. So factory overhead includes a lot of these different costs associated with the factory, except for direct materials and direct labor. So utilities on the factory, maintenance on the factory equipment, maybe cleaning expense on the factory if we have a cleaning crew that comes in and does it, depreciation on the factory, taxes, real estate taxes, or taxes payable on the factory. You know, those are all considered overhead cost. Also, and I mentioned some of these already, like when we think about like a factory maintenance worker, that's considered indirect labor because it's someone that works in the factory, but they're not actually working on the assembly line, turning raw materials into a finished good. So that's indirect labor, right? And then if we think about cleaning supplies in the factory, for example, you know, those are not materials that are used in the production process, although they do support the overall production facility, right? So indirect materials are also part of factory overhead. Utility costs, supervisory cost. Again, I also mentioned depreciation on the factory, maintenance expense on the factory, maintenance on the equipment, you know, anything like that would be considered an overhead cost. Just overall, if it's not a direct material, if it's not a direct labor, it falls into the factory overhead cost category. All right, non-manufacturing cost. Again, these are our period costs that we talked about a few slides ago. And non-manufacturing costs are expensed on the income statement when in the period when they're incurred. These type of expenses are period cost. Again, selling, general, and administrative expenses, not part of factory overhead because they're not incurred in manufacturing products, right? So again, these relate to the administrative offices, the marketing departments, those type of expense. Depreciation on the office equipment, you know, rent on the office building or mortgage on the office building, you know, things like that. All right, so I mentioned this earlier. You know, when we think about the balance sheet of a merchandiser, the balance sheet of a merchandiser has just one merchandise inventory account, and that inventory account is affected every time the company purchases inventory and every time the company sells inventory. So there's the one main merchandise inventory account with a merchandiser, right? With a manufacturer, on the other hand, we've got three different inventory accounts. All three of these accounts are considered current assets. So raw materials inventory, work in process inventory, finished goods inventory. So raw materials inventory, as you can see here, these can be direct materials or indirect materials. And once these raw materials are sent to the factory, then they're considered work in process, okay? Work in process inventory are the material costs that we are working with right now in the factory, the labor costs that are happening right now in the factory, and the overhead costs. So, so just like it shows here, partially complete products, material to which some labor and or overhead have been added. So this is when they're in the factory being worked on. Now, once they're completed in the factory, then the costs are transferred to finished goods inventory. And so finished goods inventory, as we mentioned earlier in the PowerPoint, finished goods inventory are those goods that are available for sale. Okay. And so this is all done. These are all these transactions from the purchase of raw materials until the time we sell the finished good. This is done via journal entry. These are completed via journal entries, and there are 9 of them. Nine of them get us from the purchase of raw materials until when we sell the finished goods. And we will not do any of those journal entries on week 1, but by week 2 we will be practicing those journal entries, and they're not too bad. So okay. All right, cost of goods sold and the income statement. So Cost of goods sold means something different depending on if the company is a merchandising company or a manufacturing company. But ultimately, cost of goods sold is another type of expense on the income statement, right? But as we've seen at this point, and hopefully as we remember, we're going to list our total revenue minus cost of goods sold. That gives us gross profit. And then gross profit minus selling, general, and administrative expenses gives us operating income, right? So hopefully we remember that. If not, don't worry. We're going to get practice doing it again together. But the way we calculate cost of goods sold, again, is a little bit different depending on whether it's a merchandiser or manufacturer. So in a merchandising company, and they're showing us the example down here too, but here's the formula for it. We take beginning merchandise inventory plus purchases, so plus the cost of goods purchased, minus ending inventory, ending merchandise inventory, and that gives us cost of goods sold. All right. On the other hand, for a manufacturer, because for a manufacturer, the goods that are available for sale are the finished goods. So then for a manufacturer, we used our finished goods for this calculation. So we take beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory. And remember, that cost of goods manufactured is calculated by taking our main manufacturing costs: direct materials, direct labor, factory overhead. Okay. All right, so the schedule of cost of goods manufactured, how we calculate that. So I just mentioned this a moment ago. Again, our cost of goods manufactured is made up of those main manufacturing costs: direct materials, direct labor, factory overhead. And so this is kind of the setup or how we prepare that cost of goods manufactured schedule. And it's not too bad. So we're going to take direct materials plus direct labor plus factory overhead. That gives us total manufacturing cost. That equals total manufacturing cost for the period. And then we add beginning work in process. So what we had already in the factory work in process at the beginning of the month or the beginning of the period. That gives us the total cost of work in process. And then we subtract ending work in process. So what we did not finish, what is still being worked on in the factory, that gives us cost of goods manufactured. And we will get practice preparing a cost of goods manufactured schedule together. And so we see that here. Again, it's not too bad. First, we calculate material cost, and we have kind of a formula we use for that. We take raw material beginning inventory plus purchases minus ending inventory essentially gives us the direct materials we used. Then we add direct labor, and then we add factory overhead. And you'll see some of those different factory overhead examples here. So indirect labor, factory supervisor, factory utilities, repairs, factory equipment, property taxes on factory, factory supplies used, factory insurance, depreciation expense, amortization expense. So again, anything, if it's not a material, if it's not labor, it falls into that factory overhead bucket, right? So we add these three together. That gives us our total manufacturing cost for that period. And then we take beginning work in process. We add beginning work in process. So, we're preparing this for the year 2019. And so total manufacturing costs for 2019 are $175,500. But then we're going to add what we started with in January. That's going to give us the total cost of work in process through the year. And then we're going to subtract what we didn't finish by December 31st. And that gives us, of course, cost of goods manufactured. So, you know, I think it follows like a logical order. And it makes, I think makes good sense, but we will get practice preparing this together in class together. All right, so cost accounting systems. There's two main types of cost accounting systems. We are going to talk about both of them and get practice with both of them. I will just give you guys like a, you know, a little bit of a forewarning, I guess. I mean, they're very similar, but the process cost system involves a bit more calculation. So that's why we have a little bit more time figured into the syllabus to cover that. But those are our two basic types of cost accounting systems: process cost accounting, job order cost accounting. You know, both of them are used to collect the cost data: direct material, direct labor, overhead. And the systems are similar, but again, process costing involves some additional calculation. So the major difference between the two is that process cost accounting would be used for repetitive manufacturing processes. So when the product is the same and it's a repetitive manufacturing process, like for example, you know, Coca-Cola or Honey Bunches of Oats or, you know, Angel Soft toilet paper, right? So I mean, when it's a repetitive manufacturing process, then we would use the process cost accounting system, and we're going to accumulate costs for the processes over a period of time. So for a month, for example. Where job order cost accounting are when there are custom jobs, and that's the kind of the key word: custom, right? Job order cost accounting systems are used when the jobs are not all the same. Every job is different. Every job has its own distinguishing characteristics. And for that reason, we accumulate costs per job instead of per process. So anyway, we're going to see examples of both of these as we go through the book. Well, as we go through the rest of the PowerPoint slide, and then also as we continue through our textbook as well. All right, so this kind of shows you the cost flow in a job order cost system. You know, again, you think about these are our three main manufacturing costs. So we've got materials, we've got overhead, we got labor. Those are our three main manufacturing costs. Once these costs are transferred to work in process, now they're in the factory or in the manufacturing facility being worked on. And you can see we've got 1, 2, 3, 4, 5 jobs being worked on here, right? So we're accumulating cost per job. And then once these jobs are completed, then transferred to finished goods inventory. And then once they're sold, transferred to cost of goods sold. So, you know, I mentioned earlier, these costs move through the system via journal entries. There are 9 of them. 9 journal entries get us from the purchase of raw materials until when we sell the finished good. So we will get a lot of practice with those entries as we continue through the books, and so that will be exciting. All right, and that is the end of it. So I look forward to the first day of class. Again, the first day of class, I'm going to have an exercise where we get some practice distinguishing between the different costs, and hopefully also we'll have time to get to an exercise where we prepare one of these cost of goods manufactured statements together. So I look forward to that, and I will see you guys soon. Bye-bye.